The silent economic downturn has exposed the underlying pressures on the American workforce in their 40 seconds. Despite their experience and skills, this generation faces stagnant wages, limited opportunities for advancement, and rising living costs. Alongside the highlighted growth, economic opportunities have slowed, leaving middle-aged workers trapped in financial uncertainty and highlighting a deepening, silent crisis in the labor market. Watch the full video to learn more about this issue. The Silent Recession, squeezing America's 40-something workforce. In the quiet suburbs of Middle America, a demographic pillar is beginning to tremble. They are the generation in their 40 seconds, the bridge between the legacy of the boomers and the digital native energy of Gen Z. Traditionally, this is the decade of peak earning power, the era of professional mastery, and the realization of the American dream. But as we move through 2026, the data tells a different story. Beneath the surface of steady employment figures lies a silent recession that is uniquely targeting the middle-aged workforce. This is a generation caught in a fiscal pincer movement, squeezed by the rising costs of real estate and the invisible tax of persistent inflation, while their career trajectories hit an unexpected plateau. The promise of the corporate ladder has been replaced by a treadmill that is accelerating just as the runners are reaching their physiological and psychological limits. We are witnessing the end of the traditional career arc, where the middle years were once synonymous with security. Today, the 40-something professional is the primary shock absorber for a global economy in flux. The indicators are subtle: a tightening of credit, a stagnation in discretionary spending, and a growing reliance on high-interest debt to bridge the gap between expectations and reality. The margin for error has disappeared, and for many, the silence of this recession is the loudest warning of a systemic shift that will redefine what it means to be successful in the modern age. Stagflation squeezes mid-career workers in silent recession. The crisis is not marked by the explosive headlines of a bank failure, but by the quiet erosion of household balance sheets. In 2026, the primary indicator is stagflation light, a condition where GDP growth lingers below 2% while core inflation remains stubbornly north of 3%. For the 40-something demographic, this manifests as a K-shaped divergence. While the top tier sees gains in stock assets, the vast middle is being squeezed by the rising cost of essentials. Real estate has become a particular pressure point. High mortgage rates have created a lock-in effect, where families are unable to move, effectively freezing labor mobility and trapping workers in stagnant roles. Simultaneously, credit card and auto loan delinquencies are ticking upward, signaling that the safety net of personal savings has been exhausted. Companies, facing their own uncertainty from trade tariffs and rising operational costs, have slowed hiring to a crawl. The quits rate has plummeted, reflecting a deep-seated lack of confidence among employees in finding new roles. This is the hallmark of the silent recession. A workforce that is technically employed but functionally stuck, watching as their real purchasing power is chipped away by a combination of sticky prices and a lack of upward wage movement. It is a crisis of diminishing expectations, where the once reliable path to mid-career prosperity has been replaced by a struggle to simply hold the line. Higher rates, automation stall the mid-career workforce. To understand why the 40-something workforce is stalling, we must examine the mechanisms of modern economic shocks. Unlike the singular crashes of the past, today's shocks are driven by a collapse in liquidity and the rising cost of capital. For 2 decades, the global economy operated on the fuel of low interest rates, allowing corporations to expand through debt rather than organic innovation. As the Federal Reserve shifted to a higher-for-longer regime to combat persistent inflation, the math of the corporate world changed overnight. This demographic is particularly vulnerable to the credit default swap CDS effect on a personal level. As the perceived risk of corporate debt increases, companies prioritize debt servicing over salary increases or middle management expansion. Furthermore, the mechanism of automation acts as a silent disruptor. While younger workers are trained in AI-native environments, those in their 40s are often trapped in legacy systems that are being rapidly defunded. This creates a structural mismatch in the labor market. When capital becomes expensive, the first layer to be trimmed is the expensive mid-level professional, those with high salaries but diminishing marginal utility in an automated landscape. This isn't just a cyclical downturn, it is a mechanical realignment of how value is assigned to human labor. As liquidity evaporates from the middle market, the very people who were supposed to be the economy's backbone find themselves viewed as liabilities on a balance sheet that is desperate to deleverage. Global crises warn of America's midlife economic stall. The plight of the stalled American worker finds a chilling resonance in the history of global economic collapses. In the 1997 IMF crisis, the middle classes of Southeast Asia, the Asian tigers, saw decades of accumulated wealth vanish in months as currency devaluations rendered their savings worthless. Similarly, the lost decades in Japan provide a sobering case study of what happens when a generation of workers enters middle age in a permanently stagnant environment. The salaryman culture transformed from a symbol of stability into a cautionary tale of low wages and declining social mobility. In Argentina and Turkey, chronic hyperinflation has taught us that when the exchange rate collapses and the purchasing power of the currency is destroyed, the professional class is the first to fall, as their fixed salaries cannot keep pace with the cost of living. Even in Greece, the austerity measures imposed after the debt crisis gutted the middle management layer of the economy, forcing a generation of highly educated 40-year-olds into early retirement or menial labor. These cases prove that economic vitality is not a birthright, but a fragile equilibrium. When the supercycle of debt and growth ends, the middle-aged demographic often becomes a stranded asset. These global case studies are no longer distant warnings. They are mirrors reflecting the structural risks inherent in the US economy today, where the erosion of real wages and the rising cost of debt servicing threaten to create a domestic lost generation of professionals. Mid-career stagnation slows consumption and economic growth. The impact on the US economy is profound, as the 40-something demographic traditionally drives the highest levels of household consumption. When this group stagnates, the velocity of money slows down, creating a drag on the entire GDP. We are seeing a consumption reset, where the sandwich generation, those caring for both children and aging parents, is forced to prioritize survival over discretionary spending. The real estate market feels this most acutely. The lack of trade-up buyers in their 40s has caused a stagnation in housing starts, as the path from a starter home to a family estate is blocked by high interest rates and flat wages. This demographic's inability to accumulate surplus capital also threatens the future of the venture capital and small business sectors, which rely on the savings and expertise of mid-career professionals to launch new enterprises. Instead of a fountain of innovation, the 40s have become a defensive bunker. The structural shift is visible in the declining participation rate of male workers in this age bracket and the rising underemployment of women who have hit the maternal wall, combined with economic stagnation. As the core of the American tax base flattens, the fiscal health of the nation faces a long-term challenge. The American economy, built on the assumption of perpetual midlife advancement, is now struggling to find a new engine of growth in a landscape where its most productive members are simply trying to keep their heads above water. Policy stalemate deepens the mid-career silent recession. As the silent recession deepens in 2026, the Federal Reserve and Washington find themselves in a precarious stalemate. The central bank is torn between sticky inflation, fueled by new trade tariffs, and a labor market that is beginning to crack in its most productive core. Policymakers are shifting toward a neutral rate target of 3% to 3.25%, but the relief for the 40-something worker is marginal at best. The government has introduced the One Big Beautiful Bill Act, a massive fiscal stimulus front-loaded with tax cuts and AI infrastructure spending designed to spark a productivity boom. However, these measures often favor capital over labor, accelerating the very automation that threatens mid-career roles. While the Fed signals a pause in tightening, the hawkish faction remains wary of an inflation resurgence, keeping the cost of borrowing for home and auto loans prohibitively high for families trying to deleverage. There is a growing calls for targeted reforms, such as expanding the earned income tax credit and removing age-related barriers to professional training. But political gridlock persists. The official narrative remains optimistic, pointing to resilient top-line GDP. Yet the reality for the middle-aged professional is a low-hire, low-fire equilibrium, where the government is focused on managing the statistics rather than the individual struggle. Mid-career survival strategies in a high-rate economy. Navigating a stalled career path in an era of high capital costs requires a fundamental transition from a growth mindset to a defensive, anti-fragile posture. For the professional in their 40 seconds, the first survival strategy is the aggressive reduction of lifestyle leverage. In an environment where the real interest rate remains positive, carrying high-interest consumer debt is a catastrophic drag on future mobility. Survivors are those who pivot toward skills-based diversification, treating their human capital like a stock portfolio. This means moving beyond the legacy systems of their current employers and acquiring frontier competencies in automation and AI management, ensuring they are the ones overseeing the machines rather than being replaced by them. Liquidity becomes the ultimate shield. Having 6 to 12 months of living expenses in high-yield liquid instruments provides the walk-away power necessary to negotiate in a tightening job market. Furthermore, the 40-something professional must reevaluate the sunk cost of their current industry. If a sector is undergoing structural decline, much like the retail or mid-level manufacturing of previous decades, the bravest and most effective strategy is a calculated midlife pivot into high demand, infrastructure, or specialized service sectors. This is a period where fiscal discipline and psychological resilience are more valuable than a high salary that could vanish in the next round of corporate deleveraging. The human toll of midlife economic stagnation. The weight of a stalled career often lands hardest on the front porch of a home that has become a gilded cage. For a person in their 40 seconds, the silent recession is felt in the agonizing trade-offs made every month, choosing between fully funding a child's college savings or maintaining the mortgage on a house that hasn't appreciated in years. Consider the story of a mid-level project manager, once the rising star of his firm, now watching his salary freeze while the price of health insurance and groceries climbs. The psychological impact is a form of professional vertigo, the dizzying realization that the harder one works, the less ground one gains. This demographic is currently the primary support for both the aging boomers and the emerging Gen Z, yet they have the least amount of time left to recover from a financial misstep. The stress manifests in rising rates of burnout and a quiet retreat from the social activities that once defined middle-class life. The American dream for this group has transitioned from one of expansion and luxury to one of maintenance and survival. It is a lonely struggle, as the outward appearance of success, the car, the home, the title remains, while the internal engine of financial security has stalled. This is the human face of a liquidity trap, a generation of leaders who feel like they are underwater, gasping for a breath of economic air that the current market seems unwilling to provide. From credentials to skills, reinventing mid-career relevance. The primary insight for the stalled professional is that the 2026 labor market has moved from a credential-based economy to a skills-first reality. In this new landscape, a college degree from 20 years ago acts as a legacy asset, but learning agility is the active currency. Companies are no longer hiring based on what you once knew, but on how quickly you can integrate AI-augmented workflows to solve visible problems. To break the cycle of stagnation, the 40-something worker must transition into a portfolio career model, diversifying their income streams across different projects or contractual formats rather than relying on a single, fragile employer. This shift mirrors the broader economic trend of mass customization, where flexibility is not just a perk, but a baseline requirement for a resilient workforce. Furthermore, understanding the no-hire, no-fire stalemate allows one to navigate internal corporate politics more strategically. Visibility and signaling impact have become more important than raw hours worked in a world of flatter organizations. By treating their career as a business and their skills as a dynamic product, the middle-aged professional can move from being a victim of the silent recession to being an architect of their own relevance. The era of the predictable career arc is dead, but for those who embrace the churn, it is replaced by an era of unprecedented autonomy and outcome-based value. Midlife reinvention signals a new economic paradigm. The silent recession is more than a statistical anomaly. It is the final shedding of a 20th century skin. As the 40-something workforce stands at this midpoint, the struggle they face is the birth pangs of a new economic paradigm. We are moving away from an era where time served equaled value earned, toward a world where adaptability is the only true form of security. The stagnation of today is the clearing of the deck for tomorrow's innovation. While the transition is painful and the silence of the crisis can feel deafening, it is also a call to rediscover the grit that built the foundations of the modern world. This generation is uniquely positioned to bridge the gap between human experience and technological scale, provided they have the courage to let go of the old maps. The American economy has always been a story of reinvention, and the midlife plateau is not a dead end, but a vantage point. As the debt cycles reset and the workforce realigns, those who remain standing will be the ones who realize that their worth was never tied to a corporate title or a subsidized mortgage. The true wealth of the 40 seconds lies in the wisdom to navigate uncertainty and the strength to rebuild on more honest ground. The silence is ending, and in its place, a new, more resilient chapter of the American workforce is beginning to find its voice.